All right, good evening, everybody. Welcome to a hot evening. So, Nathan, you are anyway, but it'd be nice to have a little introduction.
Sorry, just froze for a second there, Brian.
Oh, yeah. So, I was going to say, I'm sure everybody knows who you are, but you can introduce yourself just to tell them
All right.
how long you've been with us and what you do for us. Oh,
Absolutely,
wow.
absolutely.
Can you
Okay.
can you hear me now?
Yeah, you just in and out a bit.
Okay.
No problem. I'll do a short introduction. Um so my name is Nathan Gonzalez Williams. I work with Wimco as part of the Rothschild Foundation funding as a financial advisor providing financial education and guidance. Now every now and again we do these webinars to inform you on different topics to empower you to make better financial decisions, essentially. Now, I must stress, obviously, this isn't financial advice. This is guidance. And this is to allow you to have a better understanding of certain options, depending on the topic, so that you can make better decisions, essentially. If you need specific guidance, then you're welcome to come to me directly, book in a meeting, have a conversation, show me paperwork, maybe ask specific questions about your own situation. And beyond that, I can provide regulated financial advice as well. Now, today, while we have done a few webinars that have covered the topic of pensions, as I've said in previous webinars, this is a very broad and very large topic. Pensions, pension income, pension savings, different types of pension. There are many different, we could actually have a few different webinars on it. Hence, today is one of the first of a series that I'm planning to do to understand a little bit more about different elements of pension savings. And today specifically, we're going to talk about accessing your pension for income, and even more specific to that, tax-free cash. So I'm just going to share my screen so we can get the presentation up. Hopefully everyone can see that. Now, it's important to understand that what I'm saying is the most important part of this webinar. There's going to be some things on the screen that you can read, but essentially just kind of give some context to what I'm saying. And it really is for the people watching back as well. Um, as I said, it's quite a broad topic. The first few screens will kind of give us the context of what we're talking about, reintroduce different elements of pensions. But really what I want to focus on is the accessing the pension aspect. The idea was to do a topic related to areas that I'm receiving a lot of questions about when we do the meetings, about movers and shakers group on Fridays, or what I'm getting questions about when I book one-to-one meetings with WIMCO members. A lot of those questions are about accessing the pension, accessing tax-free cash. There are a lot of misconceptions as to how that is done. It's not simple, but it's not complex. It's just understanding the different rules around accessing a pension pot. Towards the end of the presentation, there'll be some time to ask questions, but um, if you want specific questions about your own situation, please book a meeting and I'll leave some details up at the end. Let's get going. Right. Now, just to introduce you back into the world of pensions, there's a very clear difference between a defined benefit versus defined contribution pension. Now, both of these could be with your employer, they could be personal, they could be set up in a different way, but most likely you're going to have a pension through your employer. This is not to be confused with a state pension. That is a state benefit, completely different. This is a pension fully encapsulated on a personal basis. And a simple difference is that defined benefit gives you a guaranteed income, and defined contribution is a pot of money you have control over that is yours to manage. Both are managed through third-party providers. Not all third-party providers allow you to do defined benefit schemes, but most do defined contribution. People like Standard Life, Scottish Widows, Royal London, Aegon. There are many, many. Um, Now, what we're focusing on is defined contribution because this is what we can access ourselves, access what we call flexibly. So we're going to focus in on that. Now, defined contribution are what most people are going to have access to. That's the kind of a scheme that is often set up when you join an employer. Now, one of the areas that we're going to focus on is the tax-free cash element. So many of you will know that as you build up a pension pot, once you access it, you can access an element of it tax-free. So this is because you're not paying income tax when you're contributing. Now, again, this might be another topic to go into more detail on the accumulation side of the pension where you're saving into it. But very quickly, when you save into a pension, you're paying an income that you haven't yet been taxed on. It comes from your employer, as in your employer pays part of your salary into your pension pot. You're not paying income tax on that. If you're paying it in privately, you're receiving tax relief. So you're getting any income tax paid back into the pension pot. So therefore, no tax has been paid on the money going into a pension. And that's the real benefit and the real nature of saving for retirement. A pension pot is a tax wrapper. It's a tax wrapper. Therefore, while it's called, while it's referred to as a retirement pot, often, it's not necessarily for retirement. You can access it from age 55 currently. That will change to 57 soon. So therefore, you don't have to stop working. You can access it just late in later life. That's what it means. So it's a tax wrapper, and one of the rules around that tax wrapper is you can access it in later life. You can't access it before age 55 or 57. Now, there's a rule around pensions where you can save up a certain amount over your lifetime. The exact figures aren't that important right now, but 25% of that could be used as a tax-free portion. Now, the lump sum allowance, sorry, the lifetime allowance, the amount you can save into a pension over your lifetime has been abolished. That was abolished in April 2023. Therefore, you can save as much as you want into a pension. It's over £1 million. But the lump sum allowance, as in the amount you can take tax-free, is capped at £268,275 per person. So that's the amount of tax-free cash you can take from a pension. And again, you can access that money from age 55 currently. That's changed to age 57 from April 2028. And on that note, just to be clear, the access age for pensions will be 10 years different from the state pension. So if your state pension ages, the access to your personal pension will be 10 years before that. Therefore, we're sort of defining the difference between your personal pension and the state pension once again. The other thing I wanted to just give you some of an insight in is the projection. So often when you receive um, policy documentation, you're going to see something like this. This is something that I just got off the internet as an example of a projection. So they're going to tell you what's in your pension pot, how much you've contributed, how much you've added, how much tax relief you may have received, how much you might have transferred from another pension pot, And that's going to make up the full amount that's invested in your pension. Now, the other important figure is what this is likely to give you at retirement. So often you will have what's called a selected retirement age. Now, this is usually just a standard default retirement age that's given to you. It's usually age 65. On here, the projections to age 67. So this is assuming that the selected retirement age is 67 on that right-hand uh, picture there. And what it's saying is your pension plan could be worth £180,000 at age 67. So when you retire, when you've selected to retire, or selected to stop working, or selected to take your pension. Now, providers will give you this indication to tell you that potentially you could take an income of X amount. In this example, it's £752 each month for the rest of your life. Now, this is an assumption. This is basically saying that based on an assumed death rate or time of death, you can take a pension every single or take an income every single year of X amount, and it will not run out of money. Now, how they do that is they essentially give you a quote in the future for an annuity where you take the whole amount, give it to an insurance company, and they pay you an income for the rest of your life. And that mirrors a defined benefit scheme. Now, here's where the problem lies. What we have is a defined contribution scheme. We're talking about defined contribution schemes here. Therefore, these assumptions and these projections aren't entirely accurate. So it is sort of your responsibility to utilize the information given to you, the amount you have invested, what it's invested in, how much it could grow, to see what it could be worth at a later date, and how long that could last you once you stop working or once you start accessing it for income. So that gives us a bit of context. It's important to understand that. Now let's focus in on how we access the pension, right? Now, obviously we have the savings route, and we can talk about it in a separate webinar. But the focus being drawing down on your pension, the one thing that is overlooked is that there is often this fear, especially in the African and Caribbean community, that this money now that you potentially have access to it, so say you've reached age 55, 57, depending on the year, and now you can access this money, that it's somehow in more danger than it ever was, so that the government can take it or they change the rules. That means you are restricted access. This is just not true. I understand the confusion between state pension and personal pensions because, there's a triple lock system and state pensions in place. And there's an understanding that, that shouldn't go anywhere. You have access to that money, but who knows, right? This pot of money is in your name. It's invested in your name, right? Yes, you don't have access to it immediately. Yes, it's not in your bank account, but it's in your name. It belongs to you. You have complete control over this cash. No one else can access it, and no one else can take it away from you. The real risk is because it's invested, it reacts to market conditions, so it can go up and down. So yes, the money can lose value, but only because of market conditions. So wars, government changes, things like that can affect the way the market performs and therefore how your pension performs. But it is always going up and down along with the market. Generally speaking, over the last few decades, the trend has been up. So if you're at pension age now in your late 50s, early 60s, or even beyond that, if you look back, you'll see that your pension and the amount that you've placed in it has grown over time. Or at least it's very, very likely that that's happened over time, over the term of 40, 50 years. So while we cannot promise and cannot guarantee anything, it is likely that that trend will continue. Now, the reason why it is likely is this pension pot is diversified across multiple different funds, multiple different geographical areas. So even though some things may happen that may decrease the pension pot. Other things in other regions might happen, or other industries might happen, which increases the value of your money. Anyway, the point here is to understand this is your money. It is fully in your control. Because what I often see is a panic happen when you get access, where people think, right, now I can access it. I need to get this money into cash as soon as possible. Otherwise, I may lose everything. Just not often the case. Now, there's another thing we need to clarify in the difference between uncrystallized versus crystallized pension pots. Now, the uncrystallized and crystallized definitions essentially give you an idea of what it means when you've accessed the pot of money. Okay? When you access your pension, you don't necessarily need to take it all into cash. Reason being, some of that pension pot is taxed money. You're going to be taxed on it as income. 25% of it is tax-free, but the other 75%, you're going to be taxed at your marginal income rate. That means depending on the amount of income you receive in that particular tax year, you're taxed at a basic rate, 20%, a high rate, 40%, or an additional rate of 45%. And it matters how much money you receive in that tax year. Now, if it's uncrystallized, that means your pension pot it hasn't been accessed yet. Nothing's happened. It's still growing tax-free. You can still contribute to it in the same way you have always been. Your allowances stay exactly the same. And your tax-free cash portion, 25%, is also growing. Now, when it's crystallized, it means the money is now active. So you could essentially access the pot. Now, you don't have to crystallize 100% of that pot. You can crystallize less than that, or 100% doesn't matter. But once you've accessed it, now you've amended the pension pot and the rules change slightly. And we'll talk about that in a second. Now, crystallize is one thing, but then there's withdrawal. So once you withdraw the money, it goes into your bank account, then the money is yours. So here's a distinction, right? Here's how we think about a pot as one pot of money. No matter how many different providers you have, so you might have some money with Aegon, some money with Standard Life, some money with Royal London, might have 3 different pension pots, 4 different pension pots, who knows? But no matter what those values are, you're going to think about your pension pot as one single entity. And once you access that money, you can crystallize it. So you can take the whole amount, for example, crystallize it, and then decide where that money goes, whether it goes into your bank or somewhere else. And that somewhere else is drawdown. So if you wanted to take 25% of your cash, you'd have to crystallize it first, take your 25% in cash, and the rest keep invested via what's called a drawdown account. Now, here's a little diagram to show you. I'm also going to put my laptop to charge. Excuse me for 1 second so I don't run out of battery. So, drawdown. This is again a diagram to show you how that process works. So, pension pot here, £100,000. A crystallization is a choice to draw that money down. And then you can take 25% as a tax-free lump sum. So now that's in your bank account. And then the rest goes into drawdown. So this one's a separate sub-account. Now, there are a couple of differences between this, which we can go into, but I think for today, the main thing to understand is this money is now accessible for income, but it's taxable. So that's £75,000 in the drawdown account. If you access that for cash, it will be taxable at your marginal rate of income tax. You can leave it invested, so it still can maintain the same amount of growth. It can grow in the same way your pension pot has always grown. But no matter what the value is, at the end of the day, you will be taxed on it at your marginal rate of income tax. Now, before we talked about taking the whole amount as one lump sum, okay, and accessing everything. This is also referred to as an uncrystallized fund pension lump sum. I know it's a mouthful, so it's often referred to as UF plus. But essentially what this means is we're not doing drawdown. We're taking all the money. We're happy to be taxed on it. So what you can do is take out the whole thing, um, the whole £100,000, make a withdrawal request, and receive both amounts of money at once. The 25% tax-free cash, which in this case is £25,000, and the taxable income, the £75,000 in your bank account. And now the government will say, right, you have earned from your pension pot £75,000 and you will be taxed on it at your marginal rate of income tax. If you are still working, because you can access your pension when you're still working, that'll be your income for that year will be in addition to this taxable income of £75,000. So you can see how if you're still working and you want to access tax-free cash, taking the taxable income part might not be the best thing to do because you'll be taxed at a higher rate of income tax if you're already earning money. Now, if you're already earning £25,000 a year and you take the taxable income of £75,000, that's £100,000 of income that you'll be taxed on at 40%. Now, obviously, the tax rate breaks down in a specific way, but essentially what we're saying is that you're a high rate taxpayer because you received £100,000 of income that year. Now, the thing to understand, and we'll go back a slide here again, is that this example, the top of the diagram is a pension pot of £100,000. This could relate to part of the pension pot and not the whole thing. So let's say, for example, that your pension pot is worth £1 million. You can use this process to access only £100,000 of it. So you might say, I need a tax-free cash. I want to take some money from my pension. I don't want to take the taxable element. I only want to take the tax-free cash. So I want, and you have to be specific about how much money you want to take. So if you want to take £25,000 in tax-free cash, you would need to crystallize 100,000, take your 25% tax-free cash, which is £25,000, and put the rest into a drawdown account. And now you would have two separate accounts, your uncrystallized pension pot and your crystallized pension pot, which is your drawdown account with £75,000 invested. Again, with an uncrystallized pension lump sum. This example can be used as a partial withdrawal. So you can access part of your pension pot, but pay tax-free cash on some of that element. Take tax-free cash on 25% of that element of it, and then pay tax on the 75%, so the taxable element of it. You could take those both at once. Now, an example of when you might want to do that is if you're not earning any other money from work. So you'll say you have no income, you have zero income, but you want to utilize your personal allowance where you're paying 0% tax on your income. So very quickly, all of us have an allowance where if we earn some money, we pay 0% tax on it. And that's £12,570 currently. So what you might say is, I want to be able to use that personal allowance and take tax-free cash. And therefore, doing some quick calculations, you can understand how much money you need to take to get a taxable income of 12,570 and also some tax-free cash. You might still want to pay some, you might want to take more of it and pay 20% income tax. Therefore, you might take a bit more. Some of it will be tax-free cash. Some of it will be taxed at 0%. Some of it will be taxed at your basic rate of income tax, 20%. Now, here's where it gets a little bit complex because those options are options, right? Now, the examples I'm giving are options, not recommendations, obviously. But those options are defined by your own objectives. So often people will get their statement from their pension company. They'll have a look at the projections and they'll say, okay, well, those projections say that I could take this amount of money in retirement. I know that it's worth this amount, and therefore I could take 25% of that tax free. Therefore, those are the numbers that I use to go off to what I can access. However, really, it should be done the other way around. You should be understanding how much money you need now, how much money will um, you require for an income, or what you want to spend and lump sum on now. And then ask the question, can I access that money without affecting my long-term objectives? In other words, my income in retirement for the rest of my life. That's the way round it should be done. This is the conversations I'm having with people where we're not understanding how much money we need in retirement. Not we're trying to see how much money we can get from our pensions in retirement. Now, the way to do this, now, obviously, you can kind of go through this whole process with a financial advisor, and that's probably the most recommended route. However, you can do some of this yourself. You can understand the very basics yourself. And one way to do that is when you're thinking about retirement, or thinking about even working or carrying on working, but maybe reducing your hours or just later life planning. Let's say that. Start at the point that you are at now. What are you currently spending? Calculate your expenses. It's a very simple exercise, just completing a budget. How much is my electricity? How much is my mortgage or rent? How much do I pay for food every month? What are your current expenses? Because that's going to inform what your future expenses are likely to be. If you've got your current expenses, you can say, okay, well, I need this amount of money every single month to essentially survive and cover my essential expenditures. So I need that amount of money regardless of what happens. That has to come in every single month. Now, you may have some other luxuries that you always want to have. So, you might like going to the theater, going to the cinema, going out to eat, whatever it may be. And you can therefore add those to your expenses. But I would often say those are not essentials and make clear those are luxuries. But if you want to have those and carry on spending on those things in later life, you should put those down too. Now, once you have this budget, once you have this amount of money that on a monthly basis you need every single month, you can then, calculate that yearly. And essentially that's the amount of income that you need going forward. The complex thing now is understanding how inflation affects that, over the years. Price changes to different things. Inflation can happen at different rates depending on what you're talking about. But this can give you a very high level understanding of what you're going to need going forward, right? But anyway, that's the income that you need to take from your pension every single year. Then you can understand, okay, to protect that income, how much can I take now as a lump sum? That is how much tax-free cash you're able to take. Now, doing it this way allows you to have a clear objective and also can inform what you need to do to get to that point. So if you're not quite at retirement yet, then you know how much more you need to save into your pension. Now, after that basic um, exercise, there is now an understanding you need to do after projecting it forward in evaluating the risk. Because obviously this money is invested in the market. There are many different things that can happen throughout the next 30, 40 years that could affect the amount of growth that you receive in the pension. You can put that money into cash. You could keep it invested in the equities. You could choose other investments that are less or more risk averse, not as risky, not as volatile. Now, those conversations are the things that you should have with a financial advisor, really, unless you have an understanding of how investments or investing works. You can get basic guidance from someone from me, through Wimco, booking a meeting. But without understanding your full, um, I guess, financial situation, and understanding all your objectives, I cannot make a recommendation as to how much tax-free cash you can take or how much income you can take. It actually takes a lot of work to get to the point where we can make a recommendation as to this is what you should do exactly. Using the basic information of your pension statements, your providers, and what you have in there at the moment, we can sort of give you a guide as to what your options are. But to understand exactly how you should use that pension for retirement is a complex task and also one that is ongoing because things change as we move through life and rules change, pension rules change, rules around access changes, rules around tax changes, tax levels change all the time. All those things are going to affect how we make a recommendation. So with that in mind, on a basic level, what you can understand is I have this amount of money in my pension. I need this amount of money every month. This is likely to happen going forward. Is on a, on a very high level basis, a guessing game, is the amount of money I currently have in my pension enough to give me an income throughout retirement? How do I use the tax-free cash to effectively minimize the amount of income tax that I'm paying? Those are the questions that we can start to answer on very, very little information, and that just comes from your pension provider. So hopefully that gives you a little bit of an insight into how the tax-free cash element, how the taxable element of your pension works. Hopefully gives you an insight into how you can start to understand how taking an income from your pension works. And as I said before, if you want to understand a bit more about what options you have and how to start get understanding of those things, book a meeting with me, have the conversation, bring your statements in, we can go through them. Often people will bring in statements that are quite old, but we can go off that in the first instance. And if we need to go into more detail, we can get up-to-date statements. So what is your current pensions worth? What are the current projections saying? And how does that match your objectives? And I can help you request those things as well. So if you want to go around calling different providers, I can help you request that. But yeah, so my details are on here. You can send me a brief message via WhatsApp, just explaining the things that you want to ask about, explaining, your situation, or you can send me an email. Emails are preferred really because it allows me to kind of organize them and get to them one by one. But yeah, if you want to WhatsApp as well, I can give you a quick call, sort of describe some situations and sort of give you a broad understanding of your situation and how I can help. And then if we need more to have another conversation, we can book a meeting in on a one-to-one basis. So I'm going to leave it there, but I'm going to give you some time to ask some questions because it is quite a complex topic. So I'll invite Brian back in to sort of manage the question taking. Hopefully his connection's a bit better.
Yeah, thanks, Nathan. I'll keep my video off because obviously it must be the heat. Has anybody got any
Yeah.
questions? I'm just looking. Jump in. Feel free to ask any questions you may have.
Not for me, Brian. I found it really useful, Nathan. Appreciate that. I like the simplified approach as well. So yeah, really easy to understand for me. Thank
Yeah,
you.
thanks, Andrew. I would say as well as this, like I said, this is quite a broad topic.
Mm.
There's a couple different elements to it. I don't want to go into every single element, so I wanted to really focus in on one part of it right today. But in future webinars, we can sort of go into more detail on other parts that are related to this as well.
Excellent. Okay, so if there's no other questions.
Hi, can you hear me?
Yeah, can hear you,
All
Davina.
right, it's Davina. Hi, thanks for that. That was really useful. And I love that you're doing this for the community as well. So that's great. I just got a local authority pension. Does any of what you said there apply to me, or is that a different thing altogether?
Is that the like a council pension?
Yeah.
So council pensions are always defined benefit. I don't believe they've had any defined contribution schemes out. They might do in the future, but they often define benefit, meaning they give you an income at retirement as opposed to allow you to manage a lump sum of money.
Yeah,
So
yeah.
yeah, I think we'll probably have to cover that in another webinar, defined benefit schemes. Um, and those can be highly complex because every single one is very different. But just so that you know,
Hmm.
um, the clear difference is that you can't really define how you access that. Your statement will tell you when you can access it and what
Yeah,
your benefits will be. And there'll be some changes depending on if you access it late or if you access it early.
yeah, yeah. No, I thought so. That's really helpful. Thank you.
No problem.
I don't think there's any more. What about the final salary? I know that was an old
Yeah, so Brad,
pension
that's a good
scheme.
question because the final salary is basically the defined benefit scheme. It's just
Right.
they just use different terms, but yeah, they're exactly the same thing. A final salary scheme is the same as a defined benefit scheme. Defined contribution scheme, also referred to as a personal pension or retirement plan, or um yeah, there's probably a few different names on it because the branding for different providers is always different. But yeah,
Yeah.
final salary schemes, just like defined benefit, will give you essentially a final salary in retirement for the rest of your life.
Okay. And do you help people? So if they took out all their pension and they wanted to keep it in another pension scheme, is there support you can give them in terms of making that decision?
Yeah, so understanding what your options are is one thing. So understanding, okay, I can take this pension, put it in a different pot, take an income from it, or use a final salary scheme to give me an income in retirement. That's one thing. The the support that I give when understanding, okay, this is what you should do in terms of transferring schemes out or moving them needs to be done on a sort of one-to-one basis and specific to your circumstances. The
Yeah.
reason being is because one thing is there are legacy benefits in pensions because rules have changed so much. So moving pension pots you could lose access to those because you've moved it from one provider to another. So we have to do a full breakdown of what your provider, what your pension pot and the provider it's with, what it gives you access to, whether it be protected retirement ages, protected tax-free cash, guaranteed rates, whatever it may be. We have to ask those questions first. So the support is there, but it is very detailed. It's a slow process.
Okay. So I think what you're saying is everybody's got personal circumstances and it's best to speak to you directly to get that sort of personal advice.